we're live on Zoom, the Thursday edition of the Not Your Average Investor Show, the JWB Rental Like a Property of the Week. I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately call GC because of his genius concepts, because he knows how to generate cash flows, because he's a great co-host, because he's got glorious Constantines. Show us your socks again.
Am I doing
GC.
this again? Okay.
Again?
I've got new socks.
I'm telling you, this kid has so many socks with his kids' names on it. I don't even know.
Man, it's the best way to get a laugh in the morning from my kids.
And because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
And with us, as always, our phenomenal, magnificent community manager, Madison the Magnificent. Say hello, Madison.
Hello, everybody.
It's dark moments for Madison currently, because she's had quite the
fine.
week if you weren't here earlier.
That's okay.
But things are looking up. Things are looking up.
It can only go up from here.
Because we are live with our community. Love seeing everybody here. If you're listening to us at some point in the future here on the podcast or watching on YouTube, just know this happened about 6 days ago. And we were all here having a great time. And you can be a part of that good time if you go to nyais.com. Did I say that clearly?
Nailed it.
Yeah. nyais.com. Register for one of these shows. Hang out with us. It is a good time. And if you play your cards right, you get to be part of the roll call.
Oh, yeah.
You ready for the roll call?
Let's do this.
Roll call time. Madison's welcoming everybody to the Not Your Average Investor Show. We got our leadoff hitter, John Henning, in his natural role today. Good afternoon all to John. We got Pedro saying classic LOL. Pedro, I don't know if I've seen you here before.
It's a new name. Is the Pedro N stand for new name?
New name. New name. Pedro, welcome to the show, man. Hope you get to stick around. We got the MVP of the Not Your Average Investor Show community, Lee Bishop, checking in with a good afternoon, everybody. We got Dean Curry from Columbus, Ohio, a friend, an official friend now that he hung out with us.
And future client investor guest.
Future guest investor. He's in the house. Yeah, Dean Curry, client thing majigger.
2 weeks.
We got Murray Stokely saying good morning, everybody.
Murray, longtime client. Murray came to the office about a week ago, I believe. I got to see him, shake his hand. Hadn't seen him in many, many years. And yeah, so I'm so glad you're here, Murray.
Yeah, me too. I'm stoked you're here, Murray. All right, we got Chris Gonzaga from the illustrious Hudson Valley, New York. Tip of the cap to you. No,
we don't tip the cap to the Hudson Valley. All right. We just talk about how awesome the
We just talk about the luscious valley of the gods. It's a playground over there. We got everybody know as Noah Randari here. He's saying hello, everybody. Greetings from California. We got Leo Faraganan.
Dun, dun, na, na, na.
Faraganan.
Dun, 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 dun.
Good morning, all to my sunny Bay Area, California. You guys will definitely rock this show. Leo, hair band enthusiast and alumni.
It's gonna happen.
We got Tony D in the house. Anthony Dida checking in from Jupiter, Florida. He says, "Where is your purple shirt, Pablo?"
Oh,
don't tell Tony. Greg doesn't know.
Am I wearing a purple shirt?
Yeah, Greg's got that blue colorblind.
I thought it was blue.
Pedro's checking in from Jersey. Good to have you. We got a bunch of great Jersey folks that are part of this community, Pedro. Hopefully you get to connect. We got Mark without a last name saying hello to all. So I'm assuming new name. Mark.
New name.
Welcome to the show, Mark. We're happy to have you. Buddy. Who else? We got Aaron O'Neill.
Love that.
The recovering lurker.
I don't know if we go with that.
Yeah, I agree. Aaron, we love when you check in. We know that you've been a part of the show forever, that we finally met IRL. Now you're checking in. Love to say your name, Aaron. Keep coming. I love saying it. Good to have you Aaron's from Boston.
B-Town.
From B-Town.
Yeah, probably my one and only favorite friend.
That's not B-Town. Boston. Boston's not B-Town. Bradenton's B-Town.
Oh, okay. Well, she's a Patriots fan.
Beantown.
Beantown. Yeah. Okay.
That's Boston. All right.
Okay. Well, there you go.
Lots to
Good
learn
to see
here.
you, Aaron.
You know who knows David Blattner? He's checking in from Massachusetts. He knows the nickname for Boston.
There we go.
All right. There we go. What else we got? Pedro is new, but previously known as Peter. Okay, Peter. And I brought my first property 2 months ago. All right. Let's go.
All right, Peter.
Love it. The hub is what David Blattner is calling Boston. Okay. That's advanced Massachusettsian. All right.
Bostonian.
Now that we're over the hardest part of my day, now it's my favorite part of the day. When Madison shares good news.
Oh yeah, that's my favorite part too. All right, everybody. Quick shout out. I don't think she's checked in, but a core value here at JWB is you're either growing or you're dying. One of our very own, our fairy godmother of our Not Your Average Investor Show, is growing and taking her real estate exam today. So send her good thoughts, good vibes, the whole 9 yards. So good luck, Jen.
Good luck to Jen Phil's ad.
Another really cool thing, some good news is our maintenance department here I sit next to them. I have the pleasure of sitting next to them, and they blow my mind every day. I thought my job had a lot to do, but I give every single one of them a tip of the cap. So they last quarter troubleshot 675 work orders requests over the phone. So that led to over $61,000 being saved for our clients because work orders were not open for things like HVAC, plumbing, stuff like that. So super cool. Round of applause to them.
Incredible, incredible. These are the hidden ways that your property management company will either deliver on returns on investment for you or fail. We can talk a lot about the advantages of things that we maybe are a little bit more noticeable, long-term leases, renewals. Those things are incredibly important, but there's thousands of other decisions that your property management company makes for you that people never talk about. And if your goals are aligned, you're doing things like our maintenance team is doing. And instead of just randomly sending a vendor out, they're solving the problem over the phone, saving over $60,000 for our clients. Incredible. Thank you so much for sharing, Madison.
Of course. My pleasure.
That's what we like to call around here. Good news.
Love that. Good news from the dark side.
Oh, yeah.
Good news from the dark side.
Always a light at the end of the tunnel.
Always a line for that. All right, let's spotlight over here. The thing. Thank you, Madison. Thank you for doing that. And I just want to acknowledge Jen for taking that test. I think that's awesome. So we're cheering for her. She's not here today because she's at the test.
She's at the
send her
test.
some love. So
when she gets her real estate license, what does that allow her to do, Pablo?
That's right. That is something interesting, right? We hear a lot from our community of whether or not they can refer people to JWB and can get a little kashish out of it. And the rules are, yes, as long as you are a realtor. So Jen, who has become a super active member of this community, is like pulling not your average folks that want to be not your average investors out of thin air because she's a fairy godmother. Mm-hmm. And she's now becoming a realtor so she can cash in on the kashish.
Absolutely. It's another passive income stream for a lot of JWB clients. They, are able to introduce their friends, family, their network, make an introduction to JWB. Of course, JWB is going to handle it from that point forward. And, when that person closes on their property, Jen, in this case, or anybody who has a real estate license who makes those referrals will earn $1,500 for every property that client closes. So they make one introduction, that client buys 10 properties or 20 properties, some serious kashish. So for anybody out there who has a real estate license or wants to go and get one like Jen, it's certainly something that can pay you back many times over.
Yeah, there you go. Marilyn Connerman from Homosassa, Florida.
Home of the manatees.
She's saying, Jen, another passive income stream. Brilliant. Also, Eddie from Hotlanta has checked in, and we've got the first family of the Not Your Average Investor Show, the patriarch and the matriarch, Ken and Carolyn Moline. We salute you. We
salute.
Yeah.
Nailed it.
We salute. You'll get it right one day. So we're going to kick off the show with a question from Tuesday. But first of all, we got some breaking news.
Breaking news.
What's the breaking news?
Breaking news. It was funny. I took my wife out on a date yesterday, and we were coming home from the restaurant, and she goes, "Did you hear about the inflation report?" And I hadn't read the inflation report yet. And I said, "No, I hadn't heard it yet. What is it?" And she goes, "Inflation was 9.1%. And I go, "What? A what?" 9.1%. I wasn't expecting it to go over 9.
Yeah.
Not many people were, but inflation is measured by the CPI. She goes, she knows that I read this stuff every single day. She's like, "I've never seen you react that way."
She's never seen quite that high a pitch.
Yeah. She's like, and I didn't expect it. But anyway, so yes, CPI, Consumer Price Index, is what the government looks to mainly to gauge inflation. And it's really noteworthy today. The inflation report came out at 9.1%. That is up from last month, which was at 8.6%. And what that measures is year over year, how much has a certain price basket of goods increased their prices. And this is really interesting, right? We know that inflation is something that is eroding the wealth of families, our country, right? Inflation is a thief. It takes your, what you have today and drops your buying power by, in this case, 9.1%. And, as I thought about that, a couple of things came to mind, right? I understand that this is something that if the Fed wasn't going to put absolutely everything they have to try to bring this number down, like this is another just moment where the Fed is doing anything they can to bring that. Like they have to, because what's happening here is, the big risk at this point, we know inflation is here. We know that there's other worldly events that are happening that are driving up inflation. But what the Fed is really trying to do right now is to not make inflation become something that is expected in the minds of you, me, Madison, all of you out there. Because at that point, if everybody expects these prices to stay the way that they are, it is super hard to get that down again. And for the strength of our country and the strength of our currency, and for, empowering families and building up families, right? You don't want your country's currency just to get, devalued by 9% all in 1 year. That's really a bad thing. So what the Fed is really trying to do is to make sure that they can get this thing under control as quickly as possible, because there's a real risk that inflation becomes a self-fulfilling prophecy. And if companies and people don't believe that inflation will have actually come down at some point, they're going to start making life and business decisions, assuming that this is what things cost. And that's a big risk. So if you read the articles, you're going to read about the Fed's ideas on how to do this. Unfortunately, the Fed doesn't have nearly as many options as they used to, meaning that, they used to be able to control this through interest rates or have an effect on this through interest rates. They tried quantitative easing. All of those things are a lot less effective or not possible today. What is possible is they can jack up short-term interest rates at historically high levels. We talked about this on the show probably a month ago when they raised the short-term interest rates 0.75 of a point. When the Fed raises interest rates, short-term interest rates, if they do it typically at 0.25 point at a time. They hadn't raised it 0.75 of a point in like 26 years since 1994. Right, so 28 years, they hadn't raised it 0.75 of a point at one time. Now the talk is minimum, they're going to raise it 0.75 of a point again, possibly a full point. So this is very impactful. The Fed is doing whatever they can to bring inflation down. And for you, what this means is that inflation is raging right now. And I want everybody, like the entire country seems to be thinking that they are a victim of inflation, right? And it does erode wealth, but you don't have to be a victim of inflation. There are ways for us to, as an investor, learn how to use inflation as something that we can profit from. I want to take us from victimhood to being the driver's seat. And I'm not going to say inflation is a good thing, but you can use inflation to your benefit. And the way you do that is you invest in hard assets. Hard assets are important. A hard asset is like a piece of real estate, because as inflation happens, the cost of goods and services go up, rents go up, and home prices go up. So your inflation hedge, your inflation protected there. And then if you really want to profit from inflation, what you do is you buy a hard asset and then you get smart debt on it. Because smart debt is debt that is low interest rate and locked in for 30 years. And if you're thinking about this like a business or even your personal expenses, you have the opportunity to lock in that cost. It's the same for the next 30 years. Well, inflationary times, what we all don't really think about is we tend to bring home more money. The problem is that we just can't buy more stuff. So if you have a cost that's just locked in for 30 years, and because of inflation, we're going to tend to bring home more money, now you have this opportunity that gets easier and easier to pay this debt down. So I want everybody to take themselves away from the negative sides of inflation and just feeling like this is thrust upon us. Open up our minds, become not your average investors, and realize that there are investments you can make that you can actually profit from inflation. One of those will be the property of the week that we're going to talk about here today.
All right. That is a concept that you tried explaining to me a couple of times. This is the one that most made sense. It's basically inflation profiting, right?
Yeah.
Like that idea that like if you lock in your hard good and you're making more money, that's a way to profit off it. I also like how you described it as like a thief, right? Like this idea that if inflation is happening, right? Like we look at gas prices, that's the most tangible kind of like canary in the coal mine of inflation.
Mm-hmm.
And as costs go up on stuff, wages don't keep up at that same rate, right? So like you're paying more and basically making less, and like your dollar is valued less. So whatever you got under the mattress is degrading in its purchasing power, and that's why it's stealing from you. But when you say buying hard assets, right? I'm going to translate for not so smart people like myself, but like you're talking about like buying a home that has a whole bunch of like goods that have already been built into it. Right. So like all the wood, all the drywall, all the steel, whatever, right? Like that's already there. And then the next house that's coming online is being built and it costs much more to build. And then that becomes the comparison to your property.
Right.
Therefore,
yes,
you are locking in at a discount this idea that the next thing is going to be more expensive and therefore set the bar for your home. So during inflationary times, your home is a great store, not your home and or your rental properties, whatever real estate you got going on. Hard goods are a store of value as these other things are going up around it.
Yeah. Because at this current time, with current construction abilities that are able to be mass produced, there's not a way to build the house for less money in 3 months or in 6 months and 9 months. And that is why over the long haul, home prices across the country have gone up around 4%. And if you think about what inflation is over the long haul, it's usually around 3% or 4%.
Yep.
Right. That's why this happens. You're inflation protected.
Okay. So we've got a couple more breaking news coming up, but because it's not 12:49, I want to show the property and then we can dive into Jerry Ortega's question from last week. But I just want to kind of take us here, magically whisk us away to 2896 Dignan Street. I don't know why Dignan sounds like the name of like an athlete that the coach is yelling for, like messing around in practice, like Dignan. All right. 2896 Dignan Street, Jacksonville, Florida, 32254. It is a purchase price of $195. That's lower than we've had.
What do you know
lately.
about that, huh?
All right, a little preview.
Brought off the back shelves.
For a 4-bedroom, 2-bathroom home, which is bigger than usual as well, leased at $1,343 and a very attractive total ROI of 11.38%. GC, before we answer Jerry Ortega's question, what do you love about this property?
I thought you would never ask.
You tend to think that.
I'll tell you why I love this property. Right. First, we're going to look at return on investment. Listen, 11% estimated returns. That's 11% on your money every single year is what this property should earn from all 5 profit centers. Very hard to find investments right now that are preserving capital, let alone earning a return on investment. So that's the first thing to take a look at. Look at what this rental property can do. Compare it not only to other rental properties, compare it to where else you have your money invested. Hard for you to look, especially over the next year, 2 years, 3 years, 5 years, and say, yeah, I'm probably going to get 11% on my money elsewhere. So that's the first place to look. But I'm going to go and tell you to look at another place that I usually tell you is not nearly as important.
Oh,
yeah. And it's not nearly as important, but I know it's going to perk up your ears right now. We're going to talk about price. Okay. Price is important. Of course, we need to fit it into your budget, but you first need to be a financial engineer and find the return on investment. But let's talk about price here. This one's under 200,000. I actually went back and looked at all of the properties of the week that we had done. The last 15 properties of the week, only 2 of them have had purchase prices under 200,000. That's 15 weeks now too, right? Home prices continue to go up in Jacksonville and in many places in the country. So what that's talking about is really rare to be able to buy a property that is under $200,000. Like the last property you bought, what was that?
225.
225.
Yep.
Very rare for you to be able to buy a property under 200,000. So, for many of you who are thinking about getting into this asset class, a very common question is, how am I able to do this? I only have this much in my budget. How do I do this so that I can buy this property? Well, the easiest thing to do is to look for a low price property. This is a low price property, 4 beds, 2 baths, priced under 200,000, very rare. So this is one that might be the right one for many of you, especially if you're on a budget.
There you go. That's a lot to love, or a little to love, however you want to put it. Huh?
A lot for a little.
And if you want to take a closer look at this property, Madison, the Magnificent, just posted it in the chat. You can download this sheet yourself, or you can go to jwbinventory.com and figure it out if you're hanging out with us in the past and you haven't gone to NYAs. All right. So this is the property. Beautiful little thing. I would not be surprised if this thing gets picked up QVC style, like we've like this happened a couple of times because of the attractiveness of it. But you see, I want to go back to what we promised Jerry Ortega. Jerry was with us on Tuesday.
Absolutely.
And he had a question that he put in, late in the show when my belly was grumbling like a beast and I had to go eat. So we promised him that we'd answer this on the show and that we're going to send him this clip. So I'm going to do my best Jerry Ortega voice.
Okay. Love it.
Hey, Greg, this is Jerry. For first-time investors.
Hey, Jerry. How you
doing? All right. For first-time investors that have less than $60K to invest, but are in their 40s and want to replace a six-figure income in 7 to 10 years, how long does it typically take to recoup the initial investment money, 60K, to reinvest it again and again for another rental investment? Turnkey seems like a great model, but slow and steady way to build a portfolio, which is not necessarily a bad thing, but is it a reality to have a portfolio of only turnkey rentals to produce a six-figure annual passive income?
All right, Jerry, great question. I was taking notes there. So I got less than $60,000 to invest, in his 40s, wants to replace a six-figure income and recoup. And I think it sounds like his model is he wants to be able to buy a property, get that 60 grand back, and then buy another one. And how is that real, right? Well, I think the first thing we need to think about is beyond real estate. Is that real very often?
No.
Like is the idea that we can like put $60,000 in and then in like 1 year or 2 years or 3 years or 5 years or even 10 years, get that $60,000 back and then reinvest. Is that normal? No, it's not. Does it happen? Yeah. You pick a stock, great. Maybe that happens or whatnot, right?
I mean, it happened for Hervé.
It happened for Hervé, right?
Multiple times.
Right. You pick a time to invest like 2 years ago in real estate, you put 20% down on your properties and then values go up 20% a year for 2 years. Can it happen? Absolutely. But I would really not want to bring you into this asset class and really take a hard look at any other asset classes that you're looking at. And I wouldn't want to go pie in the sky. I wouldn't want to go best possible case scenario and give you that expectation. So I won't do that here for rental property investing. What I would do is build out your plan, understanding the capital that you have and give you a realistic picture, assuming the rates of appreciation that we've seen over the last 40 years in Jacksonville, assuming rent rate increases that we've seen over the last 40 years as well, and build out a plan knowing that you're going to be invested in this model for the long haul and show you what your return on investment would be and what your cash flow will be after that long period of time. So I don't want to burst your bubble, Jerry, but if you're coming in and for this to be the right asset class for you, you've got to turn over the $60,000 that you invested in 1 year, 2 years, 3 years, 5 years, even 10 years. I haven't run the numbers, but that wouldn't be the right mindset for this asset class. Could it happen? Absolutely. But if we were to bring you on as a client and you were to buy that rental property and you were just hoping and banking on outsized appreciation, so that you can turn the asset class over, I think we'd be setting up our working relationship for failure, because that's not the way that we think about this asset class. We think about buying and holding. And when you do this for a 10-year or a 20-year cycle, some way along those lines, depending on your resources, you're able to control your time, or you're able to go and take vacations like you want. So it's a long way of answering it, but I don't think that this is the asset class for you if turning over that 60 grand is the top priority for you in the near term.
There you go. That's some straight talk from GC right there. I imagine you've had that conversation before, right? Like it's easy, man. As a business owner myself, I'm always like, when people are like, I want this, I want to be like, yeah, man, I want to help you out. But like, it's got to be tough to like have to reset people's expectations and something like that.
Well, I mean, I think my team gets to talk to investors, and many times they have requirements that we're just not going to hit, from a return perspective or from a cash flow perspective or from a time perspective. And I think it's a great service to tell people that right off the bat. Like, so I actually, I wish that we could work with Jerry. I think it'd be awesome, Jerry, for you to give our team a call and let's understand if this really is your goal. Many times I can't understand just through the question. So I think that would be great to explore it. But I love doing business with companies that tell me that I'm not a great fit right off the bat. I think they're really valuing my time. That's what we try to do.
Yeah. And it's unique. Your product is so unique. I don't know any company that I'm going to do business with that I know I'm going to be in business with for 30 years.
Yeah.
So, it is in your best interest.
Absolutely.
To set that up, man.
Yeah.
So I never really thought about it that way.
Absolutely.
Yeah.
I think about that a lot. There's 100 teammates behind me here that get to serve the clients that we get to bring on through this platform and through our sales team and whatnot. Yeah. And if we do a poor job of setting expectations right off the bat, we've just made their jobs and their lives a lot more difficult.
Yeah. Makes a lot of sense. All right. I'm going to ask another thing that happened here in the chat before I lose track of it, because it's relating to the breaking news before we go back to the property. But Pedro, my buddy over here, says, is deflation a thing? And does it mean anything in the same conversation as inflation as it applies to real estate? Yeah,
deflation can be a thing. It is extremely rare in real estate, but just like we talk about, as prices go up or prices inflate, right, that you can have deflation. It's an interesting question there, Jerry. We don't see it here in the United States very often. A part of that is because we have the Fed, and the Fed has a target of keeping inflation somewhere around, call it 2.5%. And their other mandate is to keep employment high. So the Fed has basically said, like, we feel like there should be around 2%, 2.5% inflation, and they're usually pretty good at doing that. But here's an interesting concept. We haven't talked a whole lot about this, but like with technology growing and expanding and exponentially getting smarter and smarter every single year here, right? When technology has an impact on the things that I buy as a consumer or the things that we buy as a company, technology usually increase cost or decrease cost? Technology tends to decrease cost. Right. You get call it the same effect, but decrease cost. If it's decreasing cost, what effect would should that have on the overall economy? Good. I don't know what it should have a deflating effect. Deflating, right? Like another word for deflation is like cost coming down. Yeah. I used to hire a house cleaner in my house, and I don't do that anymore. Now I have a Roomba or whatever, whatever that is. And so technology now has made that less costly. Yeah. And what has that done to that house cleaner in this example? That house cleaner no longer has that job, right? Like, so I'm just pontificating here. It's something I'm thinking about. I don't know the answer here, but deflation, you would think from technology would have there would be a deflating effect. The role of the Fed, though, is to keep inflation at, roughly 2.5%. So the Fed can make that happen even in deflationary times. There you go. All right, cool. So Lee Bishop has a question here that says, Gregg, I heard on a podcast that a lot of people are saying that interest rate rising is slowing the price of homes, but they will never go back down in 5 years. So now is the time to buy turnkey rental income properties? ? Yeah, a lot of good topics there, Lee. So yes, so as the Fed is waging this war on consumer price index, a large percentage of what makes up the basket of goods of consumer price index is housing. And so if you're thinking about this from the Fed's strategy, like how can I bring down the CPI? Well, I want to bring down rising home prices. And what is one way that they can do that? They are going to raise interest rates as much as they can. And that will have an effect, right? Raising interest rates will tamp down demand for housing. We're already starting to see that. Early numbers are in for, mortgage applications and, offers on homes and things like that. So that's very real. In fact, we're going to talk a little bit more about that. We have in 2 weeks, we can talk about MOI, or 3 weeks or 4 weeks. I can look at that while you continue to answer this question. Pablo and I were just going to take an updated look. Well, we look at MOI all the time, but I was going to share months of inventory with you, which is a great gauge of short-term pricing here in the Jacksonville market. 2 weeks. In 2 weeks, we're going to talk about that. Yeah. MOI is still really low. I'll give you just a little appetizer. MOI is still ridiculously low in Jacksonville. So we're still expecting to see home prices go up, especially in the short run here. But what you're seeing is, depending on who you are listening to in the media, you will hear that the sky is falling and that, home sales are down and all this. And while there is some truth to that, home sales are down and the rate of sales is slowing, what they may or may not be telling you is that months of inventory is still incredibly low and home prices are still going up. And that's what we expect to see in the short run. So to Lee's final point there, that, the time to buy is now, because even though home sales will slow, they need to slow. Like 20% appreciation last year is unsustainable. I don't want that this year. Right? I would love for home prices to raise 3 to 4, 5% a year. I mean, that would be fantastic. Is this the right time to buy? Yeah, I think this is the right time to buy, especially compared to your other choices outside of rental properties. And do I expect that home prices in 5 years are going to be a lot higher than what they are today? Absolutely.
Yeah. Chris Gonzaga is saying supply has a long way to go. And speaking of these like moments in time, we got more breaking news about mortgage rates.
Double breaking news. Man, there's so much breaking news going on.
Right?
So let's talk about interest rates. Okay. So if anybody has been paying attention, especially over the last couple of weeks, mortgage rates have actually dropped. Nationally, they have dropped about 0.5% for the last 2 weeks. I actually did some research on this. They dropped for the second week in a row. This is actually the largest decline in interest rates over a 2-week period since 2008. So a long time there. So this is pretty significant. I thought we should talk about why this is happening and how you can take advantage of this as an investor here. Now, to put it in perspective here, interest rates are still about 2.5% higher today than they were 1 year ago. So, they dropped 0.5%, but it's nowhere near where it was before. But why is this happening? Well, a week, 2 weeks ago, yesterday, as this inflation news continues to come out, investors have basically kind of like resigned themselves to the fact that a recession is happening, right? A recession is happening. In a recession or going into a recession, investors go into preservation of capital mode. And when you talk about stocks and bonds, what that means is they take their money out of equities or stocks and they put them into bonds because they have a fear of recession. Recessions generally do not treat the stock market well. And so they're going into asset protection. They're going into capital preservation mode. And so investors are dumping money into bonds because of the fear of recession. Many people aren't aware of how long-term interest rates work, right? And what are they tied to? Well, when the Fed says they're raising interest rates 0.75 of a point or a point, that's them raising the short-term interest rate. And it has an indirect effect on long-term interest rates. But if you want to see what long-term interest rates really kind of how they're acting based on the market, look to the 10-year Treasury yield. That is an investment that investors look at and say it's very similar to the type of risk and return that I would want to get. And if you look at the 10-year Treasury, if the 10-year Treasury is going up, then mortgage interest rates tend to go up. If 10-year Treasuries go down, then mortgage interest rates go down as well. And so over the last couple of weeks, people have been dumping money into 10-year Treasuries because they're fearful of a recession. And so what that does when you dump money into the 10-year Treasuries, that actually brings the yield down on 10-year Treasuries. And so that's what has actually brought down the long-term interest rates as well. And why is this happening? It's because there's this movement now that they were holding out hope that we weren't going to get into recession. And these inflation numbers, 8.6% last month, 9.1% yesterday, people are finally like, listen, there's no way the Fed can pull us in as a soft landing. There's no way that we can get inflation in check and not bring us into a recession. Whether you believe that or not, that's what's happening when it comes to mortgage interest rates. So the thing here is, how can you take advantage of this, right? Because I think this is an interesting time right now. We're getting a little bit of relief on interest rates. And it might be this temporary, and what I believe is this temporary relief that probably is not going to be here for a long time, because on the back end, on the other side here, we just talked about how the Fed is going to be raising interest rates either 0.75 of a point or a point. And they're going to keep doing this. They're going to keep pounding these interest rate hikes until they get inflation under control. And we have no clue when the war in Ukraine is going to end. We don't know when China's zero COVID policy is not going to negatively affect supply. So we would expect short-term interest rates to keep rising from the Fed, which will have an indirect effect on long-term interest rates. So right now, I really believe this is probably a moment in time where you get a little bit of interest rate relief.
Yeah.
You know, you can put you can put this home under contract here on Dignan. You can lock in your interest rate as soon as you put it under contract. You can get these interest rates right now, which are getting temporary relief, and you lock that temporary relief interest rate in for 30 years. And it's very likely that interest rates in 3 months or 6 months from now are going to be higher than what you have the option of doing today. So I think this is really timely, and it's a great time to buy a rental property, not just because of that, but again, think beyond where you're putting your money elsewhere. Hold the money that you have elsewhere accountable to the same way that you're holding this rental property accountable at 11% returns. And I think you'll see why owning this rental property right now using smart debt is a great option for you.
I mean, it seems like a heck of a deal, man. Like, you know, like we've known one of the reasons that I cashed out an IRA and bought a rental property is because I know that mortgage rates are going up. I know that prices are going up, and I know that stocks are going down, right? So, you know, like I took that action based on that. The idea that there's this tiny little blip. I mean, there's no way to time it, right? Like unless if I was sitting in the sideline right now, I'd be like, oh, amazing.
Right.
Because whatever this like short-term blip would be like, you know, that $220,000 house that I bought, I'd buy this $195,000 house. But it seems to me like this is a similar kind of like even smaller window than before. 2 years ago, when we started saying, when you started, Rich Richie came on, he goes, moment in time, generational wealth right now. And everybody started buying rental properties. And that convinced me as well. And all these other folks, this seems like another like micro moment in time where there's like a tiny dip down ahead of like a big rise up on interest rates, and prices are going to continue to keep going up. So it seems like a time for a good deal.
I think it is. I wasn't even expecting this one. Too.
Yeah.
It's just kind of happened, but I think it bears noting.
And that 10-year bond thing, that's interesting, man. So is that just like a reactionary thing that happens automatically? Like, is that a robot that is saying when this happens? Or is that like people looking at it and being like, well, this went down, so we're going to bring it down.
It's just like risk and return. It's the market speaking. So investors who could put their money into mortgage-backed securities say, well, I should earn like interest rates right now are about 4.5%, you know, or I could earn about maybe 3% in a 10-year treasury. And for them, that risk return is worth it. And it's just kind of pegged. They're like, well, I should get this return for taking on the risk of a mortgage-backed security. It should be more than a 10-year treasury because it's, you know, it's not backed by the full faith and credit of the US government. But just historically, it's really measured and tracked itself. So it's not a robot, it's the market speaking, but historically it has kind of been a peg for each of those sentiments.
So Tony D in the chat just to us goes, let's hope Drew didn't beat me to it. LOL.
He did that last time, didn't he?
Because last time we put a property and it was like everybody wanted it. I know awesome. Tony tried to get on there and Drew beat him to it. So just FYI, so everybody knows, Drew's not on the call today, but he did text me and say that he's listening while driving, Drew. So you and Tony, I'm going to step away from this one and flip a coin. Let's see who wants it. Interesting, man. That's an interesting point and an interesting opportunity. All right. I want to continue with another promise that we made last show when Miguel Angel also came a little bit late and also had a question and said, how did you look? Miguel Angel Sanudo, our hermano from Andalucía.
Nuestro hermano.
Nuestro hermano Andalucía. Oh, that's right. Yeah, is that your first Spanish on the Not Your Average Investor Show?
Tengo miedo hablar español ahora. Pero estoy tratando. My boy
GC's been taking Spanish classes on Thursdays. That's good, man.
Gracias.
That was great. All right, so Miguel Angel, that was for you, buddy. He asks, how did you learn in what locations you wanted to invest? And to give everybody context, on Tuesday's call, we talked about how JWB built their own personal 300 property portfolio. We're doing a multi-part series. They started in 2006. So about a month ago, we started in the period of 2006, 2010. This Tuesday, one of our best calls ever. By the way, I highly recommend you check it out when it comes out on the podcast on Monday. If you're listening live, if you're listening on the podcast, it already happened. Sorry, you're in the past. We discussed kind of 2010 to 2014. So Miguel Angelo was asking, how did you learn what locations you wanted to invest in back then?
Yeah, well, we learned a lot from folks who were successful to a degree that was so far beyond where we were. So mentors, gave us kind of the overall idea of where we should invest in generalities. But our mentors were not here in Jacksonville. Our mentors were in Connecticut or in San Diego. So they couldn't give us that intimate market knowledge there. But what they shared with us is the best place to benefit from all 5 profit centers are your below middle income neighborhoods. And so we understood that at a deep level, right? That's where you get positive cash flow, you get tax savings, you get principal pay down, you get home price appreciation, and you get inflation hedging. And so we looked for those types of neighborhoods first. Now, that gave us a number of different neighborhoods in Jacksonville. And that's kind of a general statement, like below middle income. Like, how do you know the difference between low income and below middle income, Pablo?
Ask people.
Yeah, you go out and you figure it out yourself, right? And sometimes you trip a little bit and you stumble, and sometimes you're wrong. And so we did a lot of that in the beginning. And there are homes in areas right now that I own that I'm not selling to you. I wouldn't sell you homes in that area because they're in low income areas. Mm-hmm. How did I learn the difference between low income and below income? I actually put my own money into it. And so I just think that it was first like understanding. So Miguel Angel being a part of this show is great due diligence. Anybody who's watching this show or listening on the podcast, if you're thinking about investing in Jacksonville, being here on the properties of the week, you get to actually see where we are investing. And there's a number of investors here in Jacksonville that just tune into the show and they're like, oh, if I see that JWB is investing on Dignan Street, I'm going to go ahead and start investing there because I know it's the right neighborhood. And we love that. I love that. But in the beginning, it was understanding this, looking and learning from mentors who gave us the big picture, and then us just going and spending our own time and our own money figuring this out and systemizing it. And, the cool thing is that we were pretty locked in for those neighborhoods in the beginning. Our neighborhoods haven't changed a whole lot, right? Sure, I have some properties that I purchased that are in low income neighborhoods that I still own today, but the vast majority of our properties were purchased right where we still sell properties today. The West Side, the North Side, South Side, Arlington. We were pretty close in the beginning, and it's been cool to just sort of, continue to scale up in those neighborhoods, improve the communities, and improve the returns on investment for our clients over the time.
Awesome, man. Well, I just want to shout out here to Sean in the chat who asks, is this property still available? And he asks because there's a couple times he was ready to pull the trigger to find out the property of the week was already spoken for, to which I replied, Sean, this one is available, right?
This one is available.
And Sean, for sure that used to happen all the time because we used to have to plan this thing out like a month ahead of time and properties were going like hotcakes. Nowadays, I'm putting a little extra effort onto old GC's shoulders over here.
Yep.
And he is only picking the property like 5 minutes before the show. So it's always going to be available unless, of course, Drew Barnhill already bought it.
There you go. There you go.
Who knows? And I think to that point, I think there is something to the idea that we talk about often. We haven't really mentioned it a lot, but like the property, what I have found in JWB's business model is that they have figured out how to widgetize this thing.
Yeah.
And they've, the whole vertical integration thing that we talk about essentially means that they have taken the variability out of as much as possible out of the experience, and everything that they offer is just like the next one, right? Mm-hmm. So like this idea that, you have this opportunity with this property, there is most likely 3 or 4 properties just like this if Drew has already pulled the trigger.
Yeah, absolutely. That's really important, right? For all of you who may be interested in this one, highly encourage you to reach out to my team. You can do that by calling our number, 904-677-6777, or go to chatwithjwb.com, or you can reach out to Madison the Magnificent and just let her know, and we'll be happy to facilitate. When you get on the phone, though, if by chance this property is no longer available, don't be discouraged. That's very normal. Because just like Pablo said, we believe that if you invest in the right team and the right model, then the properties are more or less interchangeable. Mm-hmm. And so there's a reason why Pablo now owns 3 properties. He's never seen one of them, right? Yeah. It's very, very normal. So if you happen to get on the phone and the property is already under contract, don't be bummed, right? We're going to talk with you. In fact, if you're a new client, we're going to take probably a couple of weeks, 3 weeks maybe, to get to know you before we actually start to look at properties. And when you get to that place and you look at properties, it's going to look very similar to this one here on Dignan.
Got it. All right, cool. Got a couple Q&As here.
Sweet.
This show is like writing itself today, man.
Love
this
it,
is
man.
too easy. All right, Lee Bishop, MVP of the community, says sub $200,000 house that generates over 1.3K per month in rent is a great price range, slightly higher than houses from just a year ago at the same price. I guess that wasn't a question, just a statement.
Love that, Lee. I mean, you're picking up on things because you're such an avid member of the group. You know what it was like a year ago, right? It was a lot easier to find a house under $200,000 a year ago. Now, not so much, right? Home prices, of course, have gone up. And so for you to be able to still get positive cash flow, to still be able to generate an 11% plus return on investment in today's environment is really something to take note of, Lee. So thanks for mentioning that.
Yeah. All right, here we go. Chris Gonzaga from the illustrious Hudson Valley.
Wonderful.
It's a beautiful place, just a Valley of the Kings. All right. Has JWB become part of the new circular economy? If so, in what way? And does it affect JWB's bottom line? Are you familiar with this term, circular economy?
No.
I was going to ask in the chat, but I was like, maybe I'm just an idiot.
I feel like I should know.
Chris, if you want, just text us and let us know what you mean by the circular economy. Is it a book? Is it, whatever? By the way, Chris, if you ever want to be a guest investor on the show, we'd be happy to have you. And, you can tell me all about the circular economy. I'm interested, man.
Speaking of that, if anybody is looking and would like to be a guest investor, please reach out to Madison. We have some openings. I don't know towards the end of this month, but definitely in August, we have some openings for the Thursday guest investors. So we would love to have you and share your story.
All right, there you go. Little teaser, by the way, next week on the POTW. Ooh. Speaking of guest investors, we're not just giving you one guest investor. We're not giving you two guest investors.
Hit them, Pablo.
We're giving you 3 guest investors. It's going to be a guest investor panel next Thursday.
Thrice.
I'm going to tell you more about it in a second, but I'm just really, as you may or may not be able to tell, excited about it. All right, Pedro N asks, is the house recently rehabbed? Would you mind talking more about the details of the rehab? Oh, thank you.
The house is renovated and it is just now being offered for lease. When it comes to the details of the rehab, I am one phone call away from the answer there, Pedro. I didn't look into the details of the renovation, but I know when you get on the phone with my sales team, it's something that we'd be happy to walk through with you. Scope of work, whatever you would like to look into. We have those answers. I just don't have them here for you.
Pedro, formerly Peter, may or may not have been here for past shows, but you guys have a general standard of weight, right? Like what can he be sure that you have gotten up to snuff? Yeah,
the biggest thing is you got to make sure that your major mechanicals do not have any deferred maintenance. And there's no deferred maintenance in general, to be quite honest, but mainly your major mechanicals, your roof, your AC, your electrical, your plumbing, those are your major cost centers. And all too often investors either buy a house from somebody else and those things aren't taken care of, or maybe they buy it themselves and they kind of convince themselves that they didn't need to take care of them and they end up paying too much for the house. But either way, that's one way to just really lose in rental property investing. So you need to work with a provider that has a standard for their renovations or for their new construction. We absolutely do, right? And our standard is to make sure, number one, that there's no deferred maintenance, focusing on the major mechanicals like we talked about. But the standard doesn't just stop there. It needs to be something that can be rented very quickly for a resident that wants to be in that home for a very long time. And then we want to make sure that the home is built to withstand a family living in that home for on average 4.5 years and is not going to create maintenance items for you later on down the line. So a lot goes into that standard. And yeah, just encourage you to get on the phone with my team, Pedro, and talk through more about the specifics of it.
All right. I got some kind of breaking news.
We got 3 times breaking news.
I looked up what the circular economy is.
Okay, cool. What are we doing?
I don't think you're going to be able to answer this question.
Sweet.
But I like it, right? Chris Gonzaga bringing up the circular economy. The circular economy is a change to the model in which resources are mined, made into products, and then become waste. The circular economy reduces material use, redesigns materials to be less resource intensive, and recaptures waste as a resource to manufacture new materials and product. I think what he is essentially saying is attention to reduce, reuse, recycle, and making sure that less waste is going into stuff and the waste that comes out of it gets as efficiently used as possible. I don't assume that you guys are on that tip right now, but I do know that you do have an R&D lab that is working on renewable materials and I don't know if renewable materials, but you guys have tested solar panels. Yeah. You guys have tested prefabricate,
like look at shipping containers as a way to reuse, a shipping container that might not have been used elsewhere. Correct. I know it's things that we look into, and I bet we have a number of examples of how we've contributed to, a more energy efficient experience or the circular economy, I guess, as we would talk about there. So maybe what I'll do is I'll go and I'll ask the question. Maybe we'll address that on a future show.
Yeah, there you go. And Chris is just letting you know, it's $1 trillion market and opportunity by 2030. So
all right.
if you know what's good for you, GC.
Love it. Maybe we'll get him on here to talk about that $1 trillion opportunity.
Let's go, bro. Yeah, man. So before we get out of here, anything else you want to say about this property? You want to hit the 5 profit centers? Like, I feel like we had this property on. People are going crazy about it. I know Tony D has already shot an email into.
It's been a while since somebody has purchased the property off the property of the week. Is today going to be the day?
We got maybe we got a little spoiled by it for a small run there. So
it was like an ego boost. Like it was like an endorphin high, right?
Yeah. Listen. Full transparency, right? Like this is what we are doing is building a community and all these things, but it's also a marketing thing. And me as a marketer, I love beating my chest and telling people that we're selling homes off of an internet show, QVC style. So if this happens, I'm going to give myself a high five in a second.
There you go.
And Tony, I hope you pick it up, man. Murray Stokely says, love the question and curious if there are any instances where things like solar can be marketed to get higher rent on single family rentals, or if that only makes sense for things like apartment buildings.
So this is something that we've looked into. I don't have all the details here, but we looked at it from the investment angle. And, if you can, make the investment in solar and then you reduce the utility bills for that resident, at the end of the day, you should be able to earn a higher rent, right? Because what would have been spent on utility bills for that resident now can be spent on higher rent for you. So you definitely can look at the numbers of this and say, this might be a good opportunity. The execution of it, really challenging. And that's why we decided not to go forward with it. Right. So, but I haven't asked those questions in quite a while. I know that there are really tangible things that we have done. I know the tax credits that we've received by doing certain things as well, which is wonderful. So I know that there are things right there. So I'm going to get some information there. And then I'll also kind of just ask the questions about the solar, the solar equation and why we decided not to do it. Maybe some things that we can share with all of you that might be the right thing for you on an individual basis.
If you are somewhat new to the show or don't pay a lot of attention, I'm a green nut.
Yeah. This will make Pablo very happy too. So
I get pictures from Gregg whenever he uses his reusable water bottle because he's no longer using single-use plastic.
There
right?
You go.
Like, it really makes me happy. I love the sustainability topic, so I'm pumped to entertain it, man. So this is cool. Maybe we'll do a sustainability show.
How did you not know the circular economy is my question?
I knew the circular economy.
Oh, sure you did.
I was just asking for a friend.
Okay,
everybody knows that. Everybody. All right. This has been an awesome show today, man. I don't know where an hour has just gone from giggling in the beginning and Facebook not working to Madison's great news to a bunch of great stuff.
I just feel like the last probably 2 months of shows, like the group, the audience has just contributed so much in terms of chats that are really insightful and questions and, suggestions for shows. I mean, we start each show now and we're like, hey, there were 3 or 4 really great questions that we're going to start with the next show.
Yeah.
It's just been a really wonderful experience. And I appreciate all of you out there for making this show your own. It's not me and Pablo's show. It's not Madison's show. It's your show. So love that you guys are enjoying it.
I couldn't agree more. Like I just never gets old to me that people are spending an hour of the middle of a work day on a Thursday to be here with us, add these amazing questions, incite great conversations, right? Yeah. Answer, if you have a question, chances are that there's 50 other people that have the same exact question. So there is no bad question. And it's been really, really fulfilling to get this interaction. Our numbers are back up on the show.
Oh,
right?
yeah.
We went through a small lull where I don't know if it was June was tough, but today we had 50 people.
Love it.
We had 60 people last week. If you are listening on the podcast, if you're watching on YouTube, we love you watching, man. But we would love if you joined us one of these days, right? Just go to nyais.com, be a part of our community. You're not going to want to miss next week's show. You know what's coming up next week?
Oh man, yes, I know.
I don't know if y'all heard about this, but somebody sold a house as an NFT here in Florida.
What does that even mean?
I don't know, but it's provocative. So, we had that same question. What does that mean?
Yeah.
So we found the company that did it, and their VP of business development, a gentleman by the name of Adam Brown, is coming on the show next week to tell us all about what the heck this is about,
Mhm.
right? So you're going to hear it straight from the horse's mouth, just kind of like, what does it mean? What's it, what the future holds for investors, what the
Mhm.
difference is between like buying a host with a wire transfer versus crypto. We're going to have a really futuristic looking show. I'm super, super pumped for it. And Adam Brown was just like the coolest dude.
Yeah.
Yeah. Like
Really easy to talk to.
I talked to you.
I've listened to him before.
Yeah. I talked to you like right after I onboarded him. I'm like, I kind of want to be this guy's best friend.
Yeah.
No offense.
Yeah. This company, Proppy, has
Yeah.
made really big headlines. They're kind of the industry leader, the first early adopter out there. I mean, this was, I think, the first time that had been done in the United States. And so many implications. What does this mean for you as an investor? What does this mean for the real estate industry as far as the adoption of the blockchain and how, what does this mean for you as a real estate agent or a title company or an investor? I mean, so many applications. So it's going to be awesome.
I know my question.
Yeah.
How do you turn Ernst Young Entrepreneur of the Year Award into an NFT?
Love it. Love it. Let's make that happen.
This was an amazing show. GC, you want to say bye to everybody?
I do. Thank you all. Thank you all for being here. Simple ask of you. We love you guys. We want more of people just like you to be here having fun with us. Would each of you just maybe send a text, maybe send an email to a friend and say, hey, this is where I'm going to be hanging out next Tuesday at 12:30. Would you come and join me? Go to nyais.com. Just send that to a friend. See if they'll come and hang out. It'll be awesome.
Just make sure that your friend isn't average, because out here, we are not average. See you next week.